Hello everyone, welcome to JAIIB CIB English Medium. My name is Aarti and I hope you all are doing good. So as you know, now we are preparing for CIB attempt and this is the series through which you can do your revision, through which you can solve a number of questions as per your exam pattern. So make sure you are subscribing to our channel, you are following the series and share this series with your friends and colleagues who are also planning to give this upcoming CIB exam and they want to clear in this in their first attempt. Yes, so let's start today's session and remember, whenever you are solving numericals now, try to use calculator. Okay, try to use calculator, try to remember the formulas because so many questions are there in which they are asking direct formula based question. Okay, so let's start today's session. First question. ABC company's ROIC is 18%, its G is 8%, ABC's DA is 6% and its tax rate is 30%. Now here they are saying ABC's WACC is 13%. You need to calculate EV EBITDA. What you need to calculate? EV EBITDA. Now what is the meaning of EV divided by EBITDA? See, as per this EV EBITDA, your EV is enterprise value. Yes, that is your enterprise value. And this EBITDA is your earning before interest, tax, depreciation and amortization. Yes, this interest you pay on loan amount, this tax you pay to government and this depreciation you charge on tangible fixed assets and amortization you charge on intangible fixed assets. Oh, I'm so sorry everyone. Yes, on your intangible assets. So basically we want pure earning. EBITDA says that we are calculating core business earning. Yes, core business earning. Your pure business earning. Suppose I started shoe manufacturing. So from that shoe manufacturing, what earning I am getting before deducting or before paying interest amount, before paying to the government, before deducting any depreciation, amortization amount. So that is what I am calculating with the EBITDA. Pure business earning. Yes, pure business earning. Now we are comparing our earning with the enterprise value. Means based on our earning, how much investors or purchasers are ready to pay for our business. Yes, if they want to purchase our business, how much amount they are going to value our business or how many times we are valuing our business. That is what EV EBITDA. Yes. Now, that is your EV EBITDA which we need to calculate. Now, WACC is what? That is your weighted average cost of capital. As a company, yes, I want funds. And for generating funds, I am using equities or my debt. Okay. So, for raising those funds, I need to pay dividends time to time. Yes, interest payments. All these things are my cost. Yes, so for raising funds, capital means what? For raising funds, what expenses or what cost I need to incur. For that amount, I need to take weighted average. That is your WACC. That is 13%. Now, ROIC is your return on invested capital. Yes. Now, this is your invested capital. Invested capital includes your both the amounts. That is going to be your equity as well as your debt. Yes, when we talk about invested capital, whether you have borrowed from someone or whether you have issued these shares and then you have taken the money. So invested capital is the total amount which you are going to use in your business. From this invested capital, how much earning you are generating. Yes, how much income you can generate. That is what given by ROIC. G means your growth. G means your growth. Yes, companies, when they are using more funds, they are going to multiply it. They will expand their business and the growth will be there. Then DA is your depreciation, which you charge on tangible assets, and A is your amortization. Yes, this is your amortization which we charge on intangible assets, and its tax rate which you need to pay to the government, that is your 30%. Now here we need to calculate EV EBITDA. As per the given information, we need to use here fundamentals EV EBITDA calculation. Yes or no? So what is the formula for using it? EV EBITDA equal to ROIC minus G 1 minus your DA into 1. This is your 1 minus T. Yes, everyone, this is your numerator. From your invested capital growth into 1 minus DA, your depreciation amortization amount into 1 minus T. Now, divided by the ROIC, WACC minus G. Yes, this is your denominator. Now, ROIC directly given, that is 0.18. Yes, minus G, that is 0.08. Next bracket, DA is already given 6%. 1 minus 0.30, that is your tax rate. Divided by again 0.18. WACC 0.13 minus your G, that is going to be your 0.08. So which is going to be in numerator 0.18 minus 0.08, that is your 0.10, 0.40 in next bracket, 1 minus 6, that is 0.4, and 1 minus 0.3, that is 0.7, divided by 0.13 minus 0.08, that is 0.18 into 0.05. So here your denominator is going to be 0.18 into 0.05, that is 0.009. Numerator 0.1 into 0.4 into 0.7, 0.028. Yes, divided by 0.09. So that is your 3.11. Yes, this is your answer. Yes, this is your EV EBITDA. From your earnings, you are going to value your company 3.11 times more. That is what EV EBITDA says. And this is your first numerical question. Okay. So if you remember this formula, this is the easiest question for you. Okay. Coming to next. Okay. Wait, everyone. Okay. Just give me one moment. Yes, everyone. Now, next question. The PEG ratio, that is a PEG ratio, price to earning to growth, is a modified multiple widely used by the analyst. Which of the following interpretation is correct? A PEG ratio greater than 1 indicates stock is undervalued. PEG ratio less than 1 indicates stock is undervalued. PEG ratio equal to 0 means the company is fairly valued. Last one, a PEG ratio greater than 2 always means stock is undervalued. Okay, so tell me, which is your correct answer here? When PEG ratio is greater than 1, that is stock is undervalued? No, that is your overvalued situation. Yes, that is your overvalued situation. When PEG ratio is greater than 2, always means that is no, that is also your overvalued situation, but the metrics that we are using, that is 1. Now, a PEG ratio is less than 1 indicates the stock is undervalued, or PEG ratio equal to 0 always means the company is fairly valued. Yes, everyone. So here your correct answer is going to be your answer B. Yes, that your company is undervalued when the PEG ratio is less than 1. 0 means not fairly valued, but if less than 1, that means that here your company's stock is undervalued, and less than 1 is your 0. So that how that can be your fairly valued, because 1 is, if company's amount is also 1 and here PEG ratio is also 1, then you can say that that is fairly valued, but less than 1, that is clearly undervalued situation. So correct answer is answer B. Next, XYZ Limited has a tax rate 25%, reinvestment rate 60%, company's WACC is 14%, growth rate is 10%. Calculate EV/EBIT multiple for XYZ Limited. Yes, here we need to calculate your EV/EBIT. Now, what we are calculating EV/EBIT. Now, EV divided by EBIT means the earning before interest and taxes. Yes, after adjusting your depreciation and amortization amount from this earning, after deduction of your depreciation amortization amount, what is the EBIT? And we are comparing based on our enterprise value. Yes, EV divided by EBIT means as per earning before interest and tax, how much enterprise valuation you are going to keep. That is your EV EBIT. Again, as per given data, this is your what? This is your fundamental amount. So reinvestment rate is what? Reinvestment rate means companies are earning total amount, total earning. From that, how much they are going to reinvest in their business. That is what reinvestment amount. If company earns, if company's earning is equal to suppose 100. Yes, and from this suppose they are distributing 10% dividend to their shareholders, means 10 rupees. So 90% they are going to reinvest in their business. Yes, so what is the formula we need to use here? That is going to be your EV divided by EBIT equal to 1 minus T into 1 minus RR divided by WACC minus G. Yes, everyone. So weighted average cost of capital already we discussed, minus G in numerator, 1 minus tax rate into 1 minus reinvestment rate. So here tax rate is 1 minus 0.25, 1 minus 0.60, 0.14 minus 0.10. Okay. 1 minus 0.25, that is 0.75. 1 minus 0.6, that is 0.4 divided by 0.14 minus 0.1, 0.04. So that is 0.75 into 0.4, 0.3 divided by 0.04. The correct answer is 0.3 divided by 0.04, that is 7.5. So EV to EBIT, that is going to be your 7.5. This is your answer. Yes, so please everyone try to practice more and more sums based on this EV, EBIT, enterprise valuation, other multiples, EV, EBITDA, EV, EBIT, EV, free cash flows, these things. Yes, so this is your next question. Now, coming to one more question. A company just paid a dividend of 5 per share. Dividends are expected to grow at a constant rate of 6% per year. Required rate of return by investors is 12%. You need to calculate current price, that is your P0, sharing the constant growth model. Constant growth model, or they can say Gordon's growth model. Yes, as per this model, we are going to use D1 divided by R minus G. D1 is your next year dividend. Yes, next year dividend. So if you read this question, a company just paid means this is your current year dividend. Yes, but in formula we cannot use current year dividend. So for calculating next year dividend, we will take current year dividend 1 plus growth rate. Yes, dividends are also going to increase as per the growth. So current dividend 5, 1 plus growth is your 6%, 0.06. 5 into 1.06. So next year dividend is going to be 5.3 divided by R, 0.12 minus G, that is 0.06. 5.3 divided by 0.12 minus 0.06. 0.06, that is going to be 5.3 divided by 0.06. So what is the value of your shares currently? That is 88.33. That is the fair value, that is the correct amount of your shares if you are purchasing it. Yes, so this is your constant growth model. Yes, everyone, this is the formula which we need to use here. I hope you also got the same answer. Now, next. Two companies, X Limited, Y Limited, produce and sell the same product at a selling price of 200 per unit. Okay, so this is your selling price, 200 per unit. Now, X Limited fixed cost 3 lakhs, variable cost 120 per unit. Y Limited's fixed cost 2 lakhs, variable cost 150 per unit. Required, what you need to calculate here? Calculate the break-even point in units for both the companies. Okay, and I think this is the first part. And next one is, if both companies sell 6,000 units, compute profit. Okay, So let's first calculate about break-even point. Yes, so okay, so let's talk about break-even formula. Break-even formula point is equal to fixed cost divided by contribution per unit, or sell price per unit minus variable cost per unit. So this is your X limited, this is your Y limited. Yes, so first thing that we are calculating, break-even point in units, that is fixed cost divided by 200 minus 120 for Y. Fixed cost 2 lakhs divided by 200 minus 150. Yes, now let's solve this, and in units, 3 lakh divided by 80, that is 3750 units. For Y, 2 lakhs divided by 50, 4000 units. Okay, so this is your break-even point. Break-even point means no profit or loss. Okay, if you sell at this point, no profit, no losses. Yes, that is your break-even point. So we solved the first question. Now next, what they're saying, if both companies sell 6000 units, compute their profit. Okay, so they are saying if they are selling 6000 units minus 3750, means about this 3750, whatever amount they are going to sell in X company, they are going to earn profit. Yes, and that is their units. Yes, that is their 2250 units, and in this 6000 minus 4000, that is 2000 extra units which they are going to sell, that is going to be their profits. But this is in your units. Okay, this is in your units. Now your turn is there. This is your homework part to calculate the profits, and let's see how many of you can calculate it. Okay, share your answer. Let's see how many of you can know how to calculate the profit. Please calculate it and share your answer through the comments. Yes, and if you have any further query, you can join my Telegram group as well. This is the QR code. Even you can check our chat box. In that, we have already shared the link of my Telegram group. You can join it. You can see more number of questions, discussions are going on there. You can join it, and with that, you can clear your ABFM. But remember, practice will help you in retaining the concepts. Yes, just one time reading won't help you. Read multiple times the same thing. Yes, that is how you can clear it. So that's it for the today. And apart from this, if you want to join any batches, remember the coupon code Y895, and one number is also given in our description box. You can use that number for the further queries. Yes, you can call on that number. Experts are there. They will help you for your CIB, which subject will be covered, how, which is the perfect batch at this point of time. If you haven't registered, or during the registration of your CIB, if you're finding any difficulty, experts are going to help you out. Okay, so let's wind up this session. Thank you everyone for joining. Take care and bye-bye.